First of all is a topic outline. So for our agenda in presentation, there will be 3 topics that we cover, which is in chapter 1 is introduction. We will cover the background of the foreign exchange market and the main issue of the foreign exchange market. And in chapter 2 is a literature review that we cover the translation expose, translation expose, economy expose and management practice. And lastly is chapter 3 that we cover the case study analysis that will support the theory in chapter 2. Okay, for introduction, which is the background of the foreign exchange market. The market for converting one nation currency into another is known as the foreign exchange market, which is the rate at which one currency is exchanged for another is referred to as an exchange rate. For instance, okay, Toyota converts the dollars into, which is dollars, and earns from selling automobile in the United States into Japanese yens through this foreign exchange market, which is the current level of international trade and investment would not be possible without the foreign exchange market. So it is necessary in the international business, and to enable business which is based in nation that use distinct currency to trade with one another is the foreign exchange market. So the development of a foreign exchange market can be profoundly affected by change in the international monetary system institutional structure. Okay, according to Rehman 2000, the good market approach the exchange rate will affect the stock price. Like, for example, a rise in the exchange rate of the local currency will lower the price of goods on the international market. Will result an increase in demand. Therefore, they should increase their sale, which in turn lead to increased profit and a company's stock price. Because if the stock price raise, which is the stock price raise of the local currency, so the stock price will have an impact on the exchange rate, which is a rising stock market will raise the price of share and the value of business, which will lead to demand for domestic currency on both on local and also the global scale.
Hi, my name is Shafika binti Imam. My metric number is 59405. So I would like to continue my part of presentation, which is the foreign exchange market case main issue. As we know, exchange rate system has associated with economic instability. Since 1998, the ringgit has been at its lowest point in history. The ASEAN financial crisis led to the economic collapse of Malaysia. A key driver to the ringgit's depreciation is the decline in oil prices. The ringgit reached its lower value on November 4, 2022, which was lower than the ASEAN financial crisis. The US Federal Reserve Chair Jerome Powell has said that the ultimate objective is to reduce inflation to 2% from 8.3% year-on-year in August 2022. Malaysian citizens are concerned about how long the recent depreciation of the ringgit versus the US dollar will endure and how their lives will be affected. One may simply calculate that a rise in USD will result in increased food price in Islam Malaysia.
Hi! Transaction expose is the potential increase or decrease in the value of net profit and income has been undergoing change in exchange rate since the last transaction occurred. In the context of the accounting, foreign currency transaction is the restatement of the certification data expressed in one currency into another currency. This currency is the translated through the transaction record that has been made by the user. Accountant will be various methods to protect the firm from this type of risk, such a consolidation technique from the firm financial statement and the use of the most effective accounting evaluation produced. The need for transaction of foreign currency accounting content is the particular evidence in the record of the foreign currency transaction in the book of accounting and the preparation of the individual company financial statement, as well as the consideration of the foreign subsidiary financial statement with the financial of their parent company. Financial statements are proof of profit or loss in doing exchange, either is foreign market or the country. Financial statements are in one currency for the entire group, including the subsidiaries. To do so, foreign subsidiary account must be translated into the parent functional currency. During the consideration process, the firm used different exchange rate. The quality component of the balance sheet of the translated at historical rate in the spot rate at the time. The equity capital in injection, asset and liability are translated at the current exchange rate, and revenue and expense should be translated using the spot rate at the time each transaction. Transaction exposure usually arise when firm has account receivable or payable in foreign currency, because there is a time lag between when the financial obligation is incurred and when it should be settled. If the debit is denominated in the supplier or manufacturer currency, the purchaser price to the buyer or retailer may be different on the day of statement. This is due to the possibility of the expected change in exchange rate over time. If each unit of the product is a price in the manufacturer currency and the exchange rate is unit of the retailer currency per unit of the manufacturer currency at the time of sale, then the retailer must pay for the product in its own currency if settled immediately. However, on the actual statement date, the amount due may be different. If the other hand, the purchaser price is denominated in the buyer currency, the vendor will release a different amount than what since at the time of sale. More US firms engaged in global transactions that are often dominated in foreign currency. Statement of the financial account standard foreign currency transaction requires asset and liability resulting from this transaction to be translated and reported in US dollar, with gain and loss due to exchange rate fluctuation affecting net income. Thank you.
Hi, I'm Stakila Husna binti Muhammad Fakhruddin S58460. Next, I will continue to present the literature review economic exposure. As we know, economic exposure is a type of the foreign exchange exposure caused by the effect of the unexpected currency fluctuation on a company's future cash flow, foreign investment, and the earning. Foreign exchange risk has become one of the most challenging and persistent problems. There are several factors that influence foreign exchange. First, foreign exchange and the gross domestic product. The critical macroeconomic variable relationship and the influence on the exchange rate and found the gross domestic product can influence exchange rates. Second, foreign exchange unemployment wages. With the unemployment increase, foreign exchange will also increase. Third, foreign exchange and the inflation lower. Lower inflation rate tend to see an increase in the value of any country currency.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh to Dr. Zair. My name is Nurizati binti Musmaizwandi. My metric number is 58040. I'm presenting about management practice in literature review. So, as stated by Chandra Hanif and Hassan in 2019, management practices in the context of the foreign exchange market relate to the techniques and plan employed by market players to control their currency exposure and reduce risk. This can involve a range of methods, including hedging and others. Hedging is the process of adopting opposing position in the market to lessen the chance of suffering a loss due to a negative price movement. Next, diversification. Diversification is to lower the portfolio's total risk. Assets are dispersed over a variety of currencies, nations, and industries. Risk management is entails identifying and reducing any possible dangers brought on by currency changes. Use of financial instruments. These includes using derivatives to manage currency exposure, such as options and future contracts. Last but not least, active management. Active management is the entails continually keeping an eye of the market and modifying holdings as necessary to profit from opportunities and reduce losses. Next is according to Yip Lim, Sampin and Hassim in 2020, knowing one's personal risk tolerance and investment goals clearly is another crucial component of effective management practice in the foreign exchange market. Realistic objectives should be defined along with a strategy for achieving them. Setting stop losses, take profit levels, and other risk management techniques are some examples of how to do this in order to reduce possible losses and safeguard cash. Finally, as mentioned by Erdogan, Gedikli and Imrah in 2020, using a well thought out and tried and true trading strategy can assist to reduce risk and improve chances of market success. Technical and fundamental analysis may be used with an appropriate risk management strategy as part of this. Overall, knowledge, discipline, and adaptability are necessary for efficient management practice in the foreign currency market. Market players can reduce their risk and maximize their gains in the FX market by adhering to all of those postures.
Okay, for the next part of case study analysis, I will share of the implication based of the literature review. There is two implications. First is the fluctuating exchange rates on consumer costs. Change in currency rates may influence overall inflation through their effect on import prices. Exchange rate fluctuation have two stages of affect consumer prices. First, they affect the cost of import before taking down the those who actually buy the product. Second is impact fluctuating import prices on the total cost of local manufacturing, which in turn affect the retail price at the register. Second point implication is their public debt. In March 2022, Malaysian national debt hit a high rate of USD, while in March 1967 it reached the lowest USD. To support public sector project and government spending, Malaysia will engage in massive deficit financing. Countries with high level of public debt and deficit tend to be less appealing to international investors. Even if Malaysia print more monies, it may sell massive debt. This will only lead to inflation in the long run.
Next is handling issues. Participants in the foreign currency market should be aware of these concerns and use sensible precautions to reduce risk and preserve their financial stability. The next steps can be performed to address this problem. Firstly, hedging. Hedging can assist to lower currency risk by utilizing financial products, including currency futures, options, and swaps. In order to minimize currency risk and lessen the effect of exchange rate volatility, firms and investors in Malaysia may generally adopt hedging tactics in the foreign exchange market, particularly when dealing with cross-border transactions and investment. Moreover, instead than only using currency-based instruments, diversification may also be done through investing in a variety of financial products such as stocks, bonds, and commodities. As a result, the effect of exchange rate volatility and other hazards related to the foreign currency market may be lessened. Diversification can assist to lessen the effect of hazard and preserve financial stability in the foreign currency market, but it cannot guarantee gains, lose, or remove risk. The particular diversification techniques employed in Malaysia will rely on the requirements and objective of the company or investors, as well as the current state of the company and the market. Finally, participants in the foreign exchange market should employ effective risk management strategies to minimize the impact of volatility and other risks. It's crucial to remember that successful risk management in the foreign currency market necessitates a true strategy that takes into consideration and unique requirements and objectives of the business or investor. To lessen the effect of risk and preserve financial stability, a mix of these tactics can be adopted. In order to recognize and address new developing risks in the foreign exchange market, regular monitoring and assessment of risk management technique is also helpful. Thank you.
Next, I will explain about the advantages of foreign exchange market in Malaysia. The first one is full transparency, because Malaysia has FEC, which means Foreign Exchange Control, governed by the Exchange Control Act 1953. The agency that implement this act is BNM, Bank Negara of Malaysia. By this act, Malaysia can put restriction on the foreign exchange process. The second advantage is strengthening Ringgit Malaysia. This can help strengthen the value of Ringgit Malaysia against US dollar, because the movement of foreign currency can bring up the country's profit. Next is disadvantage. The disadvantage of foreign exchange market in Malaysia is insufficient government because frequent changes of government. New government fail to make a good relationship with other countries, causing the investor to stop investing in Malaysia.
In conclusion, the foreign exchange market is very important in a country. The increase of the foreign investment into Malaysia can help them restrain the value of the market ringgit against the United States dollar. To improve foreign exchange market, government needs to robust surveillance framework in place in managing the challenges of the foreign exchange intervention, such as giving the most emerging economic centre bank have they continued to intervene in the foreign exchange market. The sustainability of the reserve accumulation naturally become the important.